Hi everyone, this is Rupal Bain, and today I'm going to be talking about taxes. Specifically, I want to answer the question, what can and can't you deduct on your tax return? And this is a common question that many musicians and performing artists have, and it's an important one that we want to get right because we all know that the more deductions we are able to claim on our tax return, the lower our taxable income and ultimately our tax. So the IRS is pretty clear about how to determine if an expense is deductible or not. And they've actually put out a law, and it's code 162. You can look it up yourself. But in it talks about 5 main criteria, and I'm going to go through that with you today. So first and foremost, the expense needs to be ordinary. That means it should be common for the industry and something that most artists and musicians would have. Examples of that could be an instrument, case, vehicle to travel to gigs and performances, sheet music, parking. All of these are ordinary expenses. The IRS would expect to see these on your tax return. The second criteria is the expense must be necessary. And here the IRS just wants to understand, did you need that expense in order to get more income? Did it help you get income faster? Did it help you save time so that you could work on getting more income? These are some of the ways that we can show an expense was necessary. The third criteria is that it must be justified. And here the IRS wants to know, how did that expense that you made connect to you getting income? So we want to be able to show in our documentation that yes, this was an expense. I had to purchase a laptop, for example, or I needed a new cell phone. It helped me get income because, I'm doing emails, I'm contacting potential contractors for, gigs and opportunities. I needed my phone so that I could, let people know that I was available to play and make phone calls, etc. So really just showing that connection between expense and income. The fourth criteria is documentation, and this is a constant theme throughout the IRS. They need proof, and you don't necessarily even need to be submitting it to the IRS, but you should be maintaining records of your own for at least 3 years. And here's what you need to have. So your bank statement, which is great, showing that you've paid that off, is one level of documentation that's helpful. It shows the amount, the vendor, the date. That's great. However, it's not quite enough. Receipts add another layer of information that the IRS really needs, and that helps break it down into an itemized cost. It shows you specific, were there other items on that receipt that may or may not be included. It also shows how much sales tax was paid. So there's more information on a receipt than there is on a bank statement, which you already knew, but just to be clear, you need to have both copies of documentation. And then specifically, as we just talked about, you should be able to document the reason why you needed that expense and how it's connecting you to more income. And the final criteria is that the expense must be ethical. Okay, this one shouldn't be too difficult, but just to be clear, if you didn't spend money on the expense, it's not something you get to use as a deduction. If you use an expense for both personal and business use, you're going to want to make sure you calculate out what portion of that item was actually used for business so that you can allocate, 50% of your cell phone costs or 35% of your vehicle costs to the business. We don't want to put 100% if we're using it for personal use as well. So those are the 5 criteria that you can use to determine if something is deductible or not. Let's go through them again really quickly. First, is the expense ordinary and common within the industry? Second, is it necessary? Did you actually need that to help you get more income, to make you get income faster, or to help you save time? Third, is it justified? Did you need that in the pursuit of income? And can you justify that? Telling a story as to how this is helping you get income. Fourth, is it documented? Do you have not only bank or credit card statements, but also the actual receipts and a reason why you needed that purchase? And then finally, is it ethical? Are you following the law? Are we doing the right thing here? If you follow those 5 simple criteria, you can be confident that you are accurately representing your deductions on your tax return. Specifically, these will go on your Schedule C, which is your profit and loss for a business. As I said in the beginning, the more deductions we have, the lower our taxable income and ultimately our tax. So we want to get this one right. I hope you found this video useful. Please check out the other videos we have on this channel to help you elevate your career not only musically, but also financially. Thanks, and see you later.